Hi everyone, I want to go over exercise 1114. The purpose of 1114 is really showing you what's called a stock dividend. In the past problems, we did a cash dividend. Sometimes companies distribute what's called a stock dividend. So instead of giving you cash, they give you additional stock. One of the reasons companies do that is it doesn't deplete cash, but you're still rewarding your shareholders by giving them something. So in exercise 14, it says on January 1st, 2022, this company had had $1,200,000 worth of common stock outstanding. That was issued at par. So par means it sold it at the par value. There was no excess, and retained earnings of $750,000. The reason why they tell you the retained earnings was $750,000 is because to do any kind of dividend, whether it's a cash dividend or stock dividend, you must have retained earnings. The company issued 30,000 shares of common stock at par on July 1st, and it had earned net income of $400,000 for that year. So again, they're just giving you some additional information about net income just to show you that you are profitable and so forth, right? In journal, what they want us to do is journal entry of declaration. So just like a cash dividend, a stock dividend that has 3 dates: the date that it's declared, the date of record, and something called a date of distribution, which is like the payment date. In this one, they just want us to do the date they declared it, all right? And that was December 10th. And they have two independent situations here. So here they tell you the par value is 10 and the market price is 15. Why they're giving you that information is really you need the 10 to really figure out how many stocks that are outstanding, because they didn't give you that information. So on a separate piece of paper, I show you that calculation. If you have the $1,200,000 and you divide it by the par value, that means they must have issued 120,000 shares. It goes on in the problem again to point out that they issued another 30,000 on July 1st. So the 120,000 is what they originally issued, plus the 20,000 that they now issued, means that they have 150,000 shares outstanding. Because they're giving a 15% stock dividend, I would take the 150,000 that I have outstanding times it by 15%. That means I'm giving shareholders 22,500 additional shares. So that's how that calculation comes about. So when you look at this journal entry, what they've debited and what they credited is as follows. They debited stock dividends by the 22,500 shares they gave up. This is the current market price, because if they did sell it, they would sell for $15. So stock dividends would increase by $337,500. Common stock distributable is an account that is holding the place for common stock. Because we didn't issue it yet, we're using this common stock dividends distributable. Here we're going to use the amount of shares they're giving away times the par value, which is that number. And this difference that goes to paid in capital and excess, just like we did in previous videos, anytime that the price, the market price, is greater than the par value, you have this excess. So this $5 excess is the difference between the 15 and the 10, or $5. Or another way you could get this number is just take the difference between these two. Or you could take 22,500 times the 5, which is the excess per each share, and get the same number. So that's part A of the problem. Part B is now they just changed the fact that the par value is no longer 10, it's 5, and the market price is 8. So again, on a separate piece of paper, what I did, so you can see the calculation a little bit better, is I took the 1,200,000. I divided by 5 the par value, and I got 200,000. 240,000. I'm sorry. 240,000 plus the 30,000 that you issued means you have 270,000 shares. I then multiplied it by the 15%, and that means you would have issued 40,500 more shares. So when you look at this journal entry here in Part B, you again see that they debited and credited as follows. They debited stock dividends, the 40,500 additional ones they shared, times the market price, which is now 8. They give you 324,000. Common stock dividends distributable would be the 40,500 times the par value of 5, which is 202,500. And it's 121,500 is just simply the difference between these two numbers, or the 8 minus the 5, which is $3 more per share, times the 40,500 shares distributed gives you that. All right, I hope this helps, and I'll talk to you soon.